In this video, we are going to talk about the situation of the world economy and how it is related to the past. So before starting this video, please like this video and subscribe to this channel for our future updates. Welcome to Pique My Interest. The decade dubbed the Roaring Twenties was characterized by a flurry of economic and social development in the United States of America. When the stock market fell in October 1929, the era came to a sudden and dramatic close, setting the way for the United States to enter the Great Depression in the following decade. Economic turmoil arose in the years that followed, with the United States economy contracting by more than 36% between 1929 and 1933, as measured by gross domestic product. Many banks in the United States failed, resulting in the loss of money for their customers, while the unemployment rate rose to more than 25% as a result of the loss of jobs. The stock market crash of 1929 and the subsequent Great Depression, 1929 to 1939, had a direct impact on practically every area of society and changed the perspective and attitude of a whole generation to the financial markets, among other things. In some ways, the period following the stock market crash represented a complete reverse of the mentality that prevailed throughout the Roaring Twenties, which had been characterized by enormous optimism, strong consumer spending, and economic expansion. Failures of the existing system were highlighted by the financial meltdown, weak growth, COVID, and inflation pressures fueled by the Russia-Ukraine war. Comparisons between today and the 1970s are frequently made, and in some respects, they are appropriate in some cases. A spike in the price of oil has slammed a global economy that was already experiencing significant inflationary pressure, just like it did in the late 1970s. During the Yom Kippur War, the OPEC oil cartel raised the price of crude oil by about 50%, marking the first time in nearly 50 years. In a similar vein, the restrictions imposed on Russia's energy exports are having an impact, though one that is thus far less dramatic. When adjusted for inflation, the price of petroleum rose to about $140 a barrel at one point last week, but it would have to rise much farther, to $180 a barrel, to surpass the previous high of $82 a barrel set in 2008, according to the Energy Information Administration. Nevertheless, increasing energy prices are something that Western governments would like not to have to contend with. Inflation in the United States has already reached 7.9% and is expected to grow even further in the coming months. For nearly every month since last summer, inflation in the United Kingdom has been higher than projected, and it would not be surprising to see it soar above 10% in the coming months. The rate of inflation remains well below the high reached in 1975 when it exceeded 25%. In post-war economic history, the first oil shock constituted a watershed moment, as it signaled the beginning of the shift away from an approach based on demand management and full employment to one centered on liberalized markets and inflation control. However, it was not until the early 1990s, after two inflationary shocks, that the new system was completely established and appeared to be able to dominate the world. There were periods of instability interspersed with crises during this time period. One of the best examples of the same phenomenon is the 3 decades between the outbreak of the First World War in 1914 and its conclusion at the end of the Second in 1945, a period that included a pandemic, a legendary stock market crash, a period of mass unemployment, and the rise of totalitarianism, among other events. This interpretation of events suggests that the long boom of the 1990s, as well as American hegemony ushered in by the end of the Cold War, was the equivalent of the Edwardian summer of the pre-1914 period. An attempt to restore the pre-war status quo was made in the 1920s, but none of the attempts succeeded, at least not in the long run. There was a brief moment in the late 1920s, following Germany's hyperinflation, when it appeared that stability was returning, but it was impossible to turn the clock back to the world as it had been before 1914. Finally, a new model was devised, with reflation, increased social expenditure, progressive taxes, and capital controls as the core of its policy recommendations. Yet again, it was a lengthy process that required patience. Between the end of Globalization Mark I, which was dominated by Britain, and the beginning of Globalization Mark II, which was dominated by the United States, more than 3 decades elapsed. After nearly 15 years, the current crisis is still going strong. A few examples include the near collapse of the global banking system, the avoidance of a second Great Depression through the printing of large quantities of electronic money through quantitative easing, barely rising living standards, populist insurgencies, the retreat from globalization, and the outbreak of a pandemic in Europe. The United Kingdom was on the verge of its first COVID-19 lockdown shortly after the pandemic broke out. There were some parallels between the mood then and today. In the same way that the greater inflation produced by Russia's invasion of Ukraine is viewed as a transient phenomenon that will delay but not derail recovery from the pandemic, COVID-19 was viewed as a temporary hurdle on the route back to normality. How does the story progress from there? It is important to note that the pandemic has not been eradicated, rather, it has just been pushed to the sidelines by events in Ukraine. Following the relaxation of limitations, infection rates have begun to climb again, and the influx of millions of refugees into Europe will make it easier for the virus to spread throughout the continent. Policies are currently being focused on the possibility of a return to the 1970s-style inflation, which might manifest itself in two stages: an initial burst of inflation, followed by a period of economic stagnation. Higher energy bills are inflationary in the short run, but they are deflationary in the long run because they increase company costs while simultaneously eroding consumer purchasing power. Though it's clear that the old model is running out of gas, the rhetoric about leveling the playing field as well as greening the economy suggests that a new economic settlement, similar to that which stabilized the world after World War II, may be waiting just around the corner. Due to the current state of perpetual crisis, it has become clear what is wrong with the current system and how impossible it will be to return to the pre-2007 state of affairs. Despite the fact that it has not yet given way to a fully developed alternative, history indicates that it will do so sooner or later. With 1900 as a starting point, the period since has followed a pattern: periods of stability and prosperity, 1900 to 14, 1945 to 1973, 1991 to 2007, during which signs of future problems became increasingly apparent, and periods of crisis, 1914 to 45, 1973 to 1991, 2007 to the present, during which a new paradigm gradually emerged. As the crisis continues and deepens, the more significant the eventual transformation will be. The International Monetary Fund, IMF, refers to the current situation as the Great Lockdown in its latest World Economic Outlook. The Great Shutdown, in our opinion, conveys the reality that the global economy is collapsing even if policymakers do not impose lockdowns, and may continue to be in collapse long after the lockdowns are lifted. What is certain is that whatever we call it, it is the most serious catastrophe the world has faced since World War II, as well as the worst economic calamity since the Great Depression of the 1930s, and it will continue to get worse. The world has arrived at this point because of divisions among its great powers, as well as incompetence at the highest levels of government that is frightening in its scope and severity. After this, we'll be on our way somewhere else. According to the International Monetary Fund, the IMF had no idea of the impending crisis until as recently as January. This was partially due to a failure by Chinese authorities to communicate with one another or even with the rest of the world. Presently, the world is experiencing a pandemic that will have far-reaching ramifications. However, there is still a lot of ambiguity. In particular, how myopic leaders will respond to this global threat is a source of considerable concern. Assuming the IMF's prediction is correct, global output per head will fall by 4.2% this year, a significant increase over the 1.6% reported in 2009, during the height of the global financial crisis. 90% of all countries would face negative growth in real gross domestic product per capita this year, compared to 62% in 2009, when China's rapid expansion helped to cushion the impact. What do you think of our video? Let us know in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go. Thanks for watching.